All right, we're keeping our eyes on these markets. Year to date, the total return on the TSX is 14.5%. It's 7.6% for the S&P 500. Question mark, of course, for so many people is, are these equity markets at a peak, or do they still have room to run? Of course, the Fed is a big component of that. For a closer look, and joining us from the TSX is Diana Avigdor. She's portfolio manager and head of trading at Barometer Capital Management. Diana, good to have you with us today.
Thanks, Catherine.
Let's talk first. Clearly the Fed and central bankers have had an outsized impact. I think most people would agree on the direction of markets. So with respect to the Fed minutes today, it seems as though it was quite mixed in terms of when the rate hike would come. What's the view from the trading floor, or trading desks, I should say?
There have been lately a quite interesting development, call it maybe a week or two ago, ever since Ben Bernanke was heard saying something along the lines of maybe the inflation target should be changed. And ever since then, that kind of triggered a kind of narrative out there on the Fed that they are trying to perhaps change some of the soundposts. So if you recall, a long time ago, a sub 6% unemployment rate meant that things were excellent and rates could go up. But here we are at 5.5, 5.6, 5.7 in the U.S., and there's no rate hike yet. So things are fluid in the sense that there have been some papers out there discussing the fact that as things have changed in the market and in the economy, liquidity conditions are different. Central banks regulation and bank regulation and liquidity provisions are such that there is no stress like in the financial crisis, that perhaps some of those economic indicators could be looking at different levels. And so to that end, I don't think we're surprised that the FOMC was mixed.
Well, let's talk a little bit further about that. You know, even going back to years ago, I'm sure I've said on air that you have to wonder whether or not the Fed is just going to continue to change the metrics or change the goalposts depending on what's needed in the economy. Nobody could have foreseen Brexit, let alone many other areas of concern. But having said that, when we take a look at the inflation, how much of a factor will that be? What do you think they're trying to do or will do?
I think given the global growth being so low, we've seen with all the stress points, Brexit being one of them, but many other macro stress points, that the possibility for deflation is a lot more scary than inflation. And so if I was a policymaker, I would love to err, if I was to not know where it's going and what to do, as monetary policy has not really helped trigger global growth. So if I was to err on the side of anything, I would want to err on the side of inflation, because we have monetary policy tools that can handle inflation, but deflation is a spiral that's much harder to contain.
So what does that mean, though, that they would actually do in terms of a policy or where we'll see rates? Does that mean rates lower for longer?
It's very possible, and it depends on so many points of stress. For example, what is going on with Europe and European growth is important, and it factors into U.S. policy. What happens with Japanese QE matters as it relates to how they're able to bring themselves out of several decades of deflationary situation, and China growth still matters. So there are some coordinated thought here in terms of global growth, one at the expense of the other. One doesn't have to do something if the other is doing okay. Economic data has come in better than expected.
Well, has it though, Diana? I mean, take a look at those U.S. retail sales. Whether it's company-specific stories that are really disappointing, like a Target and like a Lowe's. Now, they can be company-specific stories as to why their results aren't very good. But you've got the U.S. economic data showing retail sales not very strong. You've got auto sales, which might still be strong, but people are concerned that that's peaking. And then I think the housing data is somewhat mixed. And you see that in the housing furnishing companies.
It is seasonally weak in the summer for housing, for example, and retail. Everybody is gearing up back. Actually, on retail, we know that a lot of the retail sales, traditional retail sales, is now gone online. The back to school season is expected to be something like 20% better than previous. So I'm not going to Staples to buy my kids' notebooks. I'm going on Amazon and ordering everything, and it's
Are
coming
you?
in a neat. Me personally?
Yeah, are you really? Because I actually went on Amazon the other day because I wanted to see how good or not good it was in terms of all the offerings, and I understand to get some of your staples there, etc. But I don't know that it's the best site out there.
I think the numbers, I think the young kids, for example, I know that a lot of them just click, click, click. I know in terms of clothing, for example, I know a lot of people, and actually my generation that have never shopped online, that have now become a lot more comfortable with just sitting at their desk and going click, click, click. They've figured out my generation, for example, has finally figured out that they have to just know their particular sizing in 3 of their favorite stores, and that's it. We don't have to waste time anymore. I think that on the margin you are seeing some changes, even if I have a 10-year-old that still likes to pick her colors. So I go to the store.
Diana, bottom line, as it relates to where you're seeing money flow into and out of, what do you think might be the best setup for investors between now and year end?
The way we have positioned our portfolios, and we've mentioned this before, we barbelled cyclical versus non-cyclical. I think that what we've seen in the last couple of days is a little bit of coming into support levels, which is quite welcome from my perspective, because it cleans up excesses and it's a quiet period. I think that we continue to rotate into what works. We've for a long time been saying that asset management is better done tactically, as there are so many things that are changing so quickly. I mean, you and I speak about new macro situations every few weeks,
right.
Every 3 months. 3 months ago, Brexit would not have been something that you would have thought has gone through, and you wouldn't have thought that markets reacted this way. So tactical asset management for us is key. For now, we're still barbelled between cyclical and non-cyclical, as we think that the market probably works through these questions. That being said, the level of pessimism and underinvestment in the market is still high, although in the last 2 weeks has more and more people have been coming out saying, you know what, things are going to be okay. September is going to perhaps be a little sloppy, but nothing to worry about, and we stay diversified.
Okay, Diana, we have to leave it there. Thanks so much for joining us.
Thank you.
Thank you.